Okay, well, thanks, John and Joanne, for that introduction. And as the Laurentian Bank, part of the mining team at Laurentian Bank Securities, we're pleased to lend our support to this conference. For those of you who know me, I am Barry Allan, just in COVID hair and beard. Joanne has tasked me this morning to try to let you give some perspective where we are in the mining cycle. Having been around the industry since really the day of the crash, October 19th, 1987 in capital markets, I often talk about cycles in mining. And for our younger people in Laurentian Bank, they always keep looking at me and say, what cycle? So today I'm going to try to address a few things for you. Where are we in the mining cycle? And I'm going to endeavor here to show you some tangible evidence of where we are at milestones. I'm also going to talk a little bit about what contributes to the cycle. There are some issues that we will need to, excuse me, address when we talk about cycles, and maybe why this cycle is a little bit anomalous, I'm going to say. And then I'm going to try to wrap it up with, what are some of the implications about where we are in the cycle, and in particular, why a virtual conference like this is perhaps important for us to be participants in. So, starting off, where are we in the cycle? And over the years, what I've recognized is that finding an objective measure about where we are in the cycle has been a little bit problematic. But what I've come to learn is there is a nice vehicle out there that is timely and is very accurate, and it's Major Drilling, which is a domestic driller originally here in Canada, but now is international. Why a drilling company, a drilling service provider, as an indicator where we are in the cycle? Well, the drill machine is really what we call a truth machine. When people are looking for reserves and resources, they need to drill. And hence, any exploration dollar that is raised or spent by mining companies will end up in the hands of a driller. So I've taken Major Drilling partly because it's a very good public company, it's got good disclosure, and it's international. And so what I've plotted up here in this initial slide is just a look at the annual revenues of Major Drilling per year since they went public. They went public late 1993, and just look at the various cycles. Now, one of the things I would say here, and you can see that we have had some significant ups and downs. The cycle here, though, is a little bit accentuated because Major Drilling has grown over this period of time. If I go back to 1994, they had a little over 150 drill rigs. They've been a consolidator in the industry over the past number of years and have continued to grow their fleet from that 150 kind of number to well over 600. So we've got some M&A growth in here. So what I just to emphasize a little bit more where we are in the cycle and the organic part of the trend, what I did is I went through each of the MD&As for each of the fiscal years, and I backed out 12-month revenues when Major bought additional drill rigs, or at one period of time they bought a manufacturer of drilling, which they subsequently sold. So I removed all that data from the annual numbers to really accentuate where we are in the cycle, and it shows up very nicely. We can go back to 97 here and take a look, which is where this kind of first starts. It was Bre-X that kind of broke that cycle. We went down till about the beginning of 2003. Then we had quite a nice run in drilling activity and exploration activity that took us really through to 2012 with a slight what's called the sharp sell-off that we had for a year. And then what we really have been in since 2012 has been a declining environment for mining activity. Well, fortunately, that did shift, and that shifted decisively. By this, it shows up as calendar 2017, but Major Drilling have an April year end, so that would be their April year end. So I wanted to take a little bit more closer look at it. So these are the quarterly numbers, gross, uncorrected. And what you can clearly see in this presentation and slide is that mining activity really did bottom out in the fourth quarter of 2016. And again, fourth quarter for major drilling is April. So that would be April 2016. From then on, we've had an expansion of drilling exercise and exploration in the industry. And so what I would say to you, mining is back, and solidly so, and it has been for some period of time. And this slide just basically reiterates exactly when that cusp occurred. Okay, what contributes to cycles? So it's, drilling activity is one indicator and a good indicator, but what really kind of helps drive the cycle, if you will, to some better valuations. Clearly, higher or lower commodity price, and that's influenced by either economic activity, interest rates, or some form of supply side disruption in the case of iron ore. Also, we need to have investors. We need the willingness of investors to get involved. So I'll take a look at a couple things here. I'll look at some competing sectors maybe. I'll take a look at what new discoveries actually will do to the cycle. And then another bigger question is this historic trend that we've been in for the last decade or so, is the trend to passive management away from active management. And I'll address a little bit, what the implications are there as well. First, let's look at commodities. Yep, snapshot year to date, although gold probably a little bit harder off today than when I generated this chart. But look at the 1 year, 2 year, and 5 year timelines for percentage performance of the various commodities. And I grouped them here: precious metals, gold and silver, the PGM metals, which are the platinum palladium group, then what I call a steel economically driven type commodities, copper, nickel, and iron ore, then what I would say environmental or battery driven, lithium and cobalt, and then finally uranium. But I think unequivocally, what we've had here has been good metal prices right across the board. And in particular cases, when you take a look at some of the spectacular performance that we've had, like palladium as an example, it stands out like a sore thumb, or iron ore, there have been very, very good catalysts behind the move in equities driven by the commodity price. So again, we're in a very good commodity price environment, generally right across the board for a lot of the mining related commodity groups. What does that mean? And here, this is data that comes from S&P. It looks at new issue activity, and I want to just see, is the investor there? Are we raising money? Are new monies being raised and employed in the mining sector? And yeah, if I go back to 2018, I can probably convince myself that there is an investment appetite. But if I turn back the clock a little bit further, it's not so clear. So, activity really did bottom 2016. What it really says to me is that new issue mine financings really are not a good indicator of where we are in the cycle. There's so many variables that drive, does someone come to the market and raise money? It does show that there is a robust market here. But I'm going to say to you that really the level of equity financing is, in this context, is really looking at US, Canada, and UK, not really showing you that this is a robust bull market that we're in. It does show that there have been a good level of financings overall, but generally not a very good indicator. One of the aspects that I'll touch on, and there's some very good work out there by a number of people, and I've just taken some recent data that came out from the Investment Institute of Canada, just saying, looking at new fund sales. And so what they were addressing is that 2020 ETFs outsold mutual funds again for the third year in a row. This phenomena is even worse in the United States when you take a look at some of the stats put out by the Morningstar type people who monitor funds flow. Over the last decade, there's been trillions of dollars that have migrated from the active manager, and these are the people who make decisions and actively manage funds, to what are the passive funds, and these are the ETFs. And there's a reason why that is important for particularly people who are looking to raise money in the junior market, because the more money held in passive hands, the less money there is available for discretionary investment new issue investing, and that will dampen the volatility of the market overall. So generally speaking, this trend to passive management and the declining percentage of funds held by active managers and the decrease in the active managers, I think, is part of the reason why we haven't had the kinds of valuation levels that we would otherwise expect, given the level of mining activity we have, given the level of the commodity price that we are currently enjoying. It's taken something off the top. But if we look at the Canadian phenomena, which is more flow-through driven, which is a Canadian tax-driven incentive, really to help earlier stage exploration companies, the one thing that we can say, and this is just looking at the top 5 funds in Canada, there is risk money out there, and it has been generally inclining. And if indications are 2021, from all the indications that we have, and we're very active in this market, is that this year could be a record year. So far, the amount of money that is out for a raise is just under $100 million, and that's one of the highest that we've seen so far. So there is money being raised out there, and there are investors that are taking the risk in the junior mining area. So there are investors out there who are certainly looking at the sector. One of the things I know, though, having over the years, what really accentuates the capital market cycle and the bull market is the catalyst-driven event of a new discovery. And in here in this slide, what I've put up are some past examples of major discoveries where new camps. What I've bolded are where the discovery has been in a major new camp. So, going back Hemlo days, but, you can look at Ogatoya, which, Mongolia, or, the more recent one that I have put here is Marathon, which is Newfoundland. These are camps. This is where it started a whole pennies to dollars type moves in new discoveries. And they're new. Whereas the current discoveries that we have in the family, and again, this is not an exhaustive list, but I went through our universe and looked at some of the discoveries we've had, and they're all in existing mines. They're all in existing camps. They're not new discoveries. They're better zones, new deposits within existing camps. So we haven't had this catalyst of a really major new discovery at the opening of a new camp. We have had some good discoveries, albeit, which have driven prices, but not the major kind of catalyst that we normally look for. So we haven't had the support from the new discoveries. So where does this all mean? Well, yeah, we have had, and I looked here again, this is the GDX and the GDXJ, two ETFs, which are commonly followed to look at the senior gold companies and the junior gold companies. Yeah, we can say that over the 10-year period, the GDX is up, 133%, and the GDXJ is up 150% from their lows in 2016. So there has been a lift. We are deep into a cycle. All the evidence does show that. Although I would say here in this example is that we're not back to the kinds of levels we certainly saw in 2012. So there's certainly more to go. Maybe that is a new discovery that brings it, or perhaps just a change in the commodity price environment or the willingness of the investor to get involved. But we're not back to the same kind of valuation levels. And I think a part of that has been the evolution of the ETFs, which has taken some of the money out of the hands, or taken a fair bit of the money out of the hands of the discretionary managers. So we still have room on the upside. That's really where I come to at the end of the day. But again, these are broad market indices. And what's important about conferences like this is it really is equity specific. And, two of the presenters that you will hear here, I could have taken a number of them, but, you take a look at a Jaguar Mining example, over a 2-year period of time, up over 900%. Just absolutely great, stunning performance, well beyond anything of the GGX or the GDXJ. And also another one, which is Canadian-based Galway Metals, new discovery, up over 400%, in 2 years. These are both companies that are presenting at this conference. These are some of the companies that have presented at previous conference. And it also emphasizes the importance of actually sitting in and listening to individual stories. Yeah, broad market indices will tell you that we're up, but equity-specific kinds of names that you'll hear from today, there's the opportunity for much better kinds of potential gains that we can look forward to. And in this environment, we would anticipate that there will be some successes. So with that in mind, I'm going to say let's get on with the virtual day and say thank you for attending.